Welcome to The Explainer. Today we're pulling back the curtain on a company's financial story. We're talking about the profit and loss statement. Think of it like a business's report card. We're going to find out what it really says once you get past all the hype. So, picture this. You walk by a store with a giant 50% off everything sign. What's your first thought? Are they absolutely killing it and celebrating, or are they in serious trouble? Well, the real answer isn't on the sign out front. Nope, it's hidden in the numbers, and we're about to find out where.
You see, every single business has a financial story that unfolds over time. And the book where you read that story? It's called The Statement of Profit or Loss. It's basically a play-by-play of every single dollar that comes in and every dollar that has to go out.
Now, every story has a beginning, and in finance, that beginning is always the top line, sales revenue. This is just all the money that comes in the door from customers. So for our little example company here, Wannabe Rich Traders, they sold 500 items and brought in a nice 75,000 Rand. Easy enough, right? A big, flashy sales number looks great on paper. I mean, it's the engine of the whole operation. But, and this is a big but, it's only chapter 1 of the story. To really understand what's going on, we have to talk about the costs.
And that brings us to this really important idea, the cost of sales. Now, this isn't about paying rent or salaries. This is specifically the price you paid for the actual things you just sold. So for our wannabe rich traders, it's literally what they paid their supplier for those 500 units that just walked out the door with a customer.
Okay, so let's build this out. Wannabe rich traders had to pay 100 Rand for each of those units. So, 500 units, that's a cost of sales of 50,000 Rand, and now we get to do the first, most fundamental piece of math in all of business. We subtract that cost right from our sales revenue.
And boom! That one simple subtraction gives us the first major reveal in our financial story, the gross profit. It's called gross because, well, we're not done yet. We still have a bunch of other expenses to account for.
So, you take the 75,000 in sales, you subtract the 50,000 it costs to get the goods, and Wannabe Rich Traders is left with a gross profit of 25,000 Rand. Now pay attention here, because this number is so important. It tells you how healthy the company's basic model is. Just the simple act of buying a thing and selling it for more.
All right, let's circle back to our big clearance sale mystery. Remember Wannabe Rich Traders? They want to make more money, so they decide to slash their prices by 20%. But as this quote points out, that's a gamble, a big one. You have to sell a lot more stuff just to break even on that lost profit per item.
And here's how that gamble can play out. Look at these two scenarios. If that sale only brings in, say, 800 customers, look what happens. Their gross profit actually drops to 16,000 Rand. That's a desperation sale. But if that discount causes a frenzy and they sell 1,500 units, their gross profit shoots up to 30,000 Rand. That's a wild success. The only thing that separates success from failure here is volume. But wait a minute. That 30,000 Rand in gross profit, that's not what the owners get to put in their pocket. Oh no, the story is far from over. We still have to pay for all the other stuff it takes just to run the business day to day.
And these costs are called operating expenses, or sometimes just overheads. You know what I'm talking about. Rent for the shop, salaries for the staff, the money you spent on advertising that big sale, even the phone bill. You have to pay them to stay in business, but they're not part of the product itself.
So this chart here, it shows the whole journey. I like to think of it like peeling an onion. You start with that big sales number on the outside. Then you peel away the first layer, the cost of sales, and you find your gross profit. Then you peel away the next layer, all those operating expenses. And finally, you peel away interest and taxes. That small, valuable core that's left in the middle, that's it. That's the bottom line. And to see how this really works, let's look at another company, Irving Limited. They start with a huge gross profit, 380,000 Rand. Looks amazing, right? But watch what happens. Operating expenses immediately chop out over 200,000. Then interest and tax take another slice, almost 100,000 combined. And just like that, their really impressive story ends with a much smaller number, 201,600 Rand.
And that right there is the whole point. Net profit is the ultimate number. It is the final score. It's the only thing that tells you what a company has truly earned after every single bill has been paid. It is the final grade on that report card.
But believe it or not, our story has one last twist, a spooky one. There's a hidden cost out there, a silent profit killer that never sends an invoice and can sneak up on any business.
Right. Imagine you own a store. Your computer says you have 100 widgets in the back room. So you go to do a physical count, you count them up, and there are only 98. Wait a minute. Where did the other two go?
This little mystery has a name. It's called shrinkage. And yeah, it's the official accounting term for inventory that just vanishes for any reason other than being sold to a happy customer. It's a loss, plain and simple.
Now, shrinkage happens for all sorts of reasons. Sure, it could be theft from staff or from shoplifters, but it can also be things breaking in the stockroom or products expiring and becoming worthless. It can even be something as boring as a simple typo in the records.
And this isn't just a minor headache. It has a real cost. Let's say a company, Zenith Dealers, does a stock count and realizes 2,000 Rand worth of inventory is just gone. That's not just $2,000 of missing product. No, that is a 2,000 Rand expense that they have to write down, and it comes directly out of their final profit.
This is like the ghost in the retail machine. The company paid good money for that inventory, fully expecting to sell it and make a profit. But instead, because of shrinkage, that potential profit just, poof, it vanishes into thin air.
So there you have it. From the top line of sales, through the middle line of gross profit, past all the hurdles of expenses and even shrinkage, all the way down to that all-important bottom line. You now know how to read the story. So I'll leave you with this. The next time you look at your favorite company, ask yourself, what story are its profits really telling you? Thanks for watching The Explainer.